Hi, this is Rohit Srivastava and we are recording a market discussion. This is Saturday the 17th of November 2012. I have with me Ajay Maheshwari and I thought it would be a good idea if we had a one-on-one discussion rather than a monologue so that everyone can get a good idea of what the markets look like.
It's great to have Rohit Srivastava for a discussion. Welcome Rohit in the interview. And guys, we will be touching upon various asset classes over next 2 to 3 years kind of horizon, which will benefit all the investors and all the followers of Rohit to understand his views on the market. To start with, what do you see evolving on charts, especially currency to start with?
I think USDINR is the one thing that gives a clear picture that it's in a long-term upward trend. I think that's something that I've been saying again and again. Starting from the lows of 38 that it made in 2008, it has been showing impulsive moves which we've been marking as the beginning of a bull run. And it's a long-term pattern which will play out year after year. But basically, you're making higher tops and higher bottoms. You moved from 38 to 52, then you went back to 44, and starting from 2011 onwards, we moved from 44 to around 52, then back to 48, then to 57, then back to 52, reached 51.30 recently, and now we started what we call a very strong advance, which should go way above the 57 level in the months ahead. So I think we can be looking at 60 plus in the next 2 months.
When we were at 51, 52, a lot of people were expecting it to go down to 47, 48 and be there for some time, like 1 year or 6 months. But the view you were telling us is like completely on the upside, means we are moving towards 60. What kind of risk will it put to the interest cycle? Because I'll put you a question, a lot of HNIs I meet and a lot of AMCs, they suggest that people should be in debt, long-term debt rather. Okay, when the interest rate comes, RBI reduces the interest rate, obviously bond prices will go up and people will have an opportunity to make money in long-term secured paper. So what are your views on that? Is that strategy right for a retail or HNI investor?
Contradictory view when it comes to interest rates. I know that the pressure is to lower rates, and the RBI has been saying that if inflation comes down, rates should come lower. The issue that we face, and essentially it is now this relates to the long term of markets itself, is that when you study monetary cycles, and I put the stock market in the context of the contractile cycle, which is an expansion and contraction of money over 50-70 year period, then we are at the stage where if you have to grow further from here, you need an inflow of money from somewhere. Now we try to do it through expansion of domestic money in 2007 with stimulus that immediately ended up resulting in inflation. So the only way out of this situation is that you attract foreign money. Now when I look at USDINR and I see that it's in a long-term upward trend, it clearly indicates that somewhere it is going to be very difficult to attract foreign money or USD into the country, even though we are trying very hard to put things in place to do that. The chart does not the chart of USDINR is not in agreement with that view. Now what does it mean? What it can mean is that as the currency rates actually move higher, it is going to put pressure on inflation. Okay, at some point, maybe you do get one cut in interest rates in the first quarter of next year because the inflation rates are plateauing. But at some point of time, inflationary pressures are going to come right back. And I think probably RBI is also seeing that, which is why they've been holding back on rates. And even to manage your currency, you might need to raise rates. So when I actually put out the chart of interest rates, the 10-year bond yield chart in my countertype article, I showed that it was in a long-term, three-wave rise. Basically, it had rates moved up in early part of the early let's say 2006-07. Okay, then they moved down dramatically, and then after that, after 2007-08, once they went down, they moved back up again. Okay, and the sense is that they would make a new high above the high that they made in the previous cycle before you get a peak in interest rates. Now so far that has not happened, and the news around lower rates has been very strong. But at the back of my mind, I feel that at some point there is a missing spike in interest rates where the 10-year treasury bond yield might go above 10%, which means into double digits before interest rates actually peak, and then interest rates actually start coming down. So I think they're playing the bond market cycle a little early. That's my sense.
Conventional wisdom is just leading to hope. Quarter after quarter, people are just hoping that there will be a rate cut, there will be a rate cut. So what would be your crisp advice to the investor who has some money to park in long-term bonds? Should he wait for the opportunity to come in? Means, are we really looking forward to a scenario where the rate can go up and stay there for some time? Because as we speak, inflation is high and the growth is slowing down, and the currency challenge, as you have mentioned. So it is time to hold on and wait for some time before getting into bonds, or one should start deploying money in a phased manner?
You need to wait because you don't have a confirmation that rates are headed lower, and the currency risk appears to be a very serious one, and unless you've really gone over it, one should not jump to that conclusion. So I think that's one that we just need to wait it out.
Next question, Rohit, I would put it in this way. What are your views on gold? In two simple terms I would ask it. In short-term trading point of view and long-term. See, to my view, the wealth of most Indians would be at all-time high at this point in time, because they invest in property, they invest in gold, and both are at top. So wealth is at all-time high, and it is important to give them a view of these things also. So gold in terms of short-term trading trend means gold in dollar term and gold in rupee term. So what would be your view on that?
I think gold faces a very unique situation where, because you are dealing with floating rate currencies, the typical thought is that if you expand the currency, the price of gold should reflect that inflationary trend, which it has been doing over the last 10 years. But because you are in floating rate currencies, you don't really see the currency move. So if you say the dollar has been weakening, the dollar has crashed, I say the dollar has already crashed. The dollar index doesn't have to fall to reflect that, because it's a floating rate currency benchmark and not a fixed rate. So it doesn't really reflect the real purchasing power, which is reflected through rising commodity prices. But what we are seeing strongly more recently is a trend where the dollar gets stronger, and which puts downward pressure on commodity prices, and especially even gold. But in doing so, you also need to look at what is happening at the local currency level. So you could see downward pressure on gold in COMEX because of a rising dollar, but you would see upward pressure on gold in MCX because of a falling currency or the depreciating USDINR. And therefore, probably in rupee terms, there might not be much to gain or lose till gold has really hit some kind of a meaningful low in dollar terms. So it's really a difficult trade from here on. It's not going to be as easy as it's been. At some point of time, when it probably bottoms in dollar terms, is where you would like to catch it in rupee terms as well. So, but till that point of time, I think it's going to be a difficult trade with volatility on both sides.
Okay. Sitting here at this level of Nifty, let's take Nifty now. Let's talk about Nifty and Sensex. See, it has hit resistance at 5770, and now it has been struggling for like last 1.5 months to move above or below. What are your views on Nifty?
For the last couple of months, I was considering, whether the market would peak in August. First time I looked at that potential, and then we got a turnaround rally. After that rally from the October high, there was a chance that it stopped there, but I needed a confirmation, which is why I waited. The fall in October, November was again corrective, so we couldn't really call a certain top. Also, there was a huge similarity between what we saw in, we've been seeing in fact a 2-year cycle. You see 2008, 2010 and 2012. All three have a similar pattern. I'll tell you what the pattern is. The pattern is that the markets rallied from a low in August, when volatility was extremely low. September was a very strong rally in all of these 3 years. Okay, the markets peaked in October. Okay. And in 2007-8, the run-up continued all the way till January, wherein the October high was surpassed, but it was mostly driven by mid-caps. The main indices did not really go very far. 2 years later, 2010, again you had a September rally on, which was preceded by low volatility. The October high was taken out in November, but it did not continue all the way into January. The markets peaked by November Diwali itself. This year you see a very similar pattern to what we saw in 2010, where the market rallied in September, consolidated in October, and all I was looking for is the potential that the final fiscal would actually surpass the October high, just the way it did in 2010. The difference is that this time you did get a November run-up, but it did not surpass cross that high, which is why it took some time to actually call whether the run-up was over or whether we would stretch all the way into January. I think this week's market behavior, the last 4 to 5 days now, to me confirms that the possibility of a further run-up is now almost ruled out, which means that the bear market rally that we saw from December of last year, almost 11 months now, is very high probability over. I don't see much chances of it. I would put a very high chance that it's over. There's not much chance that it should head up. 5650 becoming the key resistance level, we should be looking at the potential of it heading lower. And this scenario is further pressured by what is happening around the world. We've been seeing different markets topping over the last 3 months at different stages. Just like in 2008, the US topped in October, India continued till Jan of 2008, and Europe also started making multiple tops from July all the way till January before it actually sold off. And you're seeing the same kind of pattern now, where US topped in October, has started falling. Europe was not falling till I think last week. It was still in a trading band, and yesterday it has broken that band. So while negative cues may appear a little reduced from the US yesterday, now Europe has started its decline. So you're going to get more negative cues from Europe. China, which was a hopeful market, has again started breaking down. And India, which was hanging on in the hope of maybe one final run-up prior to the winter session or further announcements, has also broken a key support at 5600. So one by one, each of these markets has given up, showing that we've now entered a bear market, not just in India but probably around the world.
What kind of levels would you put in, like multiple horizon value, like 3 months, 6 months, 1 year plus? Because the downside you're talking about is quite serious, and it is imminent for us to understand before placing our bets. So I would rather ask you to give us some numbers, where and what levels would you foresee in future?
During 2010-11 was it the market fell in small legs, and overall did not go below 4500. And it was what we call technically a falling channel. The entire rise of the last year again has been some kind of a channel which has been in smaller legs. My sense is that at some point of time, now if you're starting the third leg down from 2010, it could be a sharper decline, a faster one. And simply if I just take the size of 2010-11 and fit it to this high, and I would end up with a target of 4250. So to me, 4250 1 year is what I would put as a conservative target if the markets are not to go down too much. But one should be open to the risk given what is happening around the world. If all economies slowing down, monetary tightening happening in terms of money supply growth, then you need to be open to the risk that lower levels can happen. But I think at least that much looks like a potential target in this time horizon, and hopefully with more speed this time.
One more question, Rohit. Let's say I have some investable surplus now, okay, I have some money to invest, and after understanding your view, Nifty, gold, everything we are cautious about, what should I do with this money? Means, when you say that there is some time before investing in bonds also, so what should one do with this money? Should it be parked into liquid funds, short-term funds, or you have any other way to play out?
I think, like you said, gold, we discussed gold is probably an investment a little later down the line. Bonds too would be an investment maybe a little later down the line. So the only immediate investment from an Indian perspective which I can see is USDINR. As long as you can hold on to it, I recommend it to a lot of people who have had to get out of long-term stocks that they were holding on to for many years. I've told them if they can, and especially if they are abroad, move their money into a dollar account and hold it there till the currencies are still depreciating. And that would probably be the best hedge also against inflation in India. I'm not sure real estate right now is a good hedge against the inflationary pressure that you're seeing. It's already moved up quite a bit. The one hedge that I can see actually right now is the currency. Gold would have been ideal, but because gold would be falling in dollar terms, it might not be that much of a hedge, but only a holder of money. The key hedge, the right hedge would probably be USDINR. So that's the only investment I can see. One may consider short-term liquid funds which are investing in government bonds. Those would be of lesser risk, but generally avoid corporate and other riskier bonds. But short-term government bonds till interest rates have truly peaked might be a fair place.
Could be the length of it. Means how much time are we going to spend there? Is it like going to be a sharp downside and then we collect there, we start investing there, let's say we get 5,400, 5,300. Is it the right time to start deploying money, or one needs to simply wait out for some time and let the down run pass through?
There are on time cycles, there are two studies, one which I put up along with the Fundertype report saying that we could be in a winter till 2030. That's around 1 year prior to the election. It's a good time because if you just look at the up and down moves from 2007, the 2008 bear market from peak to bottom was approximately 11 months, January 2008 to October 2008. Then you had a recovery phase which lasted all the way up to 2010. Again, the next downward leg from 2010 to December of 2011 was around 13 months, and then you had 11 months of recovery. So if we have peaked over here in November, even if I just take that average, 11 to 13 months, which means at least for the next 1 year into October or January of 2013-14, we could probably be in a downward phase before markets pick up again. So that's the first expectation I would have if we peaked over here. The second is from a global perspective, a lot of time cycle studies that I have seen point towards somewhere around 2016. Now I don't know how India would respond to that time period. Would we start basing out and bottoming out, much ahead of other markets? It's possible. We would have to see what happens there. But I think the first sense I can say that at least the next 1 year looks bad.
And what kind of a number would you like to put, or a range would you like to give us in Nifty over the next 6 to 12 months?
I think you need to be open to the risk of the market going below the lows we saw last year. We've seen each leg of the bear being smaller so far. 2007-8 was very deep. 2010-11 was less deep. Some people would say that 2012-13 should not be anything. It should just be a range-bound market. I'm not of that opinion simply because I don't expect the 90s to repeat. The 90s was a plateau which formed after a peak in interest rates and inflation in India. And in that plateauing market, you got a range-bound market where Sensex moved between 2,800 to 4,500 for several years. So the same kind of situation where say Nifty stays between 5,000 to 6,000 for several years is not something that I would expect. In Elliott wave, you get alternation, which means each business cycle alternates at different degrees of time, and you would expect something different to happen, this time. So my sense is something different would happen. It would not be a range. It would break these ranges on either side as it continues to develop.
Can we pick some stocks now, like where you would give a cautious guidance to the investors, wherein they've been making long-term highs, or where one need to be cautious about?
I think when I'm saying that you ended a bear market rally, what we saw in 2010-11 was that several sectors continued to do well, especially defensive sectors, and therefore there is a sense that even if the market heads lower, if it does go in smaller legs, there will be stocks or sectors that might do well. It is possible that happens, but it might be a little early to say so. However, if you do enter a bear market from here, I think one has to take a much more protective stance. Most sectors, like we even saw during this time period, especially the weak ones, infrastructure, real estate, banking, did very poorly. Metals, those associated with the global markets did very poorly. So I think even in an index, 60 to 70% of these stocks would probably not do very well. So it would come down to trying to find the 10% or 20% which do well. And so unless you're really sure about what you're buying, and just up to 10 or 20% of your portfolio, the rest of it I think is likely to face a lot of trouble. I would, rather than take specific names, the point is that even the best of stocks go through a bad phase when you get a bear market. Valuations fall even for companies that report positive earnings. Dividend yields go up irrespective of what is happening at a company level. bear market get really severe. So even if you are in a good stock which you think is growing for its own reasons, or there is some kind of story behind why a particular stock should be performing and you don't want to move out of it, the right thing would be would be that at least you hedge that part of your portfolio which you are holding on to. A good hedging strategy often is up to 1.6 times your portfolio, which is just the beta of a typical high volatility portfolio or a mid cap portfolio. So a 1.6 times hedge to your portfolio at least on the downside in Nifty futures, I think is one that people should take, where they are holding on to particular stock ideas that they like. Apart from that, most sectoral themes should do poorly and one should be out of them.
Lastly, what would be your views on crude oil? Because that has been moving quite widely in this current range where it is stuck now. How should one take it?
I think commodity prices are coming under pressure since last year. They've been making lower tops and bottoms. However, the process of the fall has been very slow versus what we saw in 2008. So I think we need to get used to the idea that speed is likely to be slow, but they are going to be on a downward trend. You will see them fall, then you will see a retracement, then they will fall again, then again you will see a retracement. But generally, I think it looks like commodity prices are in a downward move. There was some hope built up in September where the CRB index made a high, but we are starting to see lower tops and bottoms in that again. So we keep watching out for what happens on the commodity side. But historically, what we've seen is sometimes you get a late commodity rally after equities peak. It happened in 2008 as well. Equities peaked in 2007-8, early part of 2008. Most equities had started falling. Commodity prices, gold continued to rally till March 2008, oil continued to rally till May 2008. Would the same kind of situation happen today? So far it's not visible, but it's possible that one particular sector like oil, if certain reasons do erupt, like we are hearing about tensions in the Middle East, it's possible that you get a run-up in particular commodity prices, not across the board, because most of them would be weakening.
Thanks a lot, Rohit. The discussion has been very helpful, and I think investors will place them in the right fashion for the upcoming challenges. Thank you, Rohit. That's all for this session, guys.
Thanks a lot. Thanks, Ajay.